So you've decided to invest in mutual funds, but unsure whether to invest the lump sum way or the SIP way. I'm here to solve this problem for you. So let's start with the lump sum route of investing. Lump sum investing is when you invest a large amount of money in a mutual fund in one go. Let's say you have 1 lakh rupees to invest and you buy units of a mutual fund with all of this money in just one go. This is called as lump sum investing. Now this causes a problem for us. For example, we'll assume that the NAV or the net asset value of the mutual fund you want to buy is at 50, which means you get 2000 units of this mutual fund. But then the very next month, the NAV of this mutual fund falls to 45, which means you'll be at a 10% loss within a month. This means you need to predict the right time to buy the mutual fund using the lump sum route. You'll have to be very lucky to predict the right time to invest your money in the market. And even the best of investors out there can't really predict this. So to solve this problem, we use the SIP route. With SIP, you invest small amounts of money every month in mutual funds. This helps us average out the price at which we buy units of a mutual fund. Sure, it may happen that you don't get returns like that of the lump sum investment if done at the right time. But like I said before, you'll have to be very lucky to predict the right time to buy. Now let's take a live example to check out how this works. We're going to take the data of PPFAS FlexiCap Fund Direct Growth Plan. And to see how this works, we're going to use the data of 2022. Let's say you invested 1 lakh rupees in this fund on the 13th of January 2022. On that day, the NAV of this fund was at 55.0629, which would have given us 1816.104 units. Similarly, if you started an SIP of this mutual fund starting from the 5th of Jan for 8,333 rupees, which is the 1 lakh divided over 12 months that we'll be investing. Now the total investment that we've made in this mutual fund gives us 1956.498 units. Now to check out the performance of our investment, we can see on the 30th of December, the NAV of this mutual fund is at 51.0328. And by the lump sum route, our 1 lakh has turned into 92,680.87. And through the SIP route, our investment of 1 lakh has turned into 99,845.57 rupees. This looks like a loss for us in the short term. But if we check it out after 6 months, on the 31st of May 2023, our investment as a lump sum has turned into 1,06,427.86. And our investment in the SIP route has turned into 1,14,134.65, which means there's a huge difference of 7% in output between the two ways of our investing. This shows us that investing in mutual funds the SIP way is the best way. But what if our lump sum investment was done on the 17th June of 2022 when the NAV of this mutual fund was at its lowest for the year? We would have been allowed 2,201.04 units. And by the 31st May of 2023, our investment would have gone up to 1,28,400.50. This is possibly the best outcome that we can achieve, but you'll have to be extremely lucky to predict that this date is the right one to invest in the mutual fund. So instead of trying to predict when to invest in a mutual fund, it's better to start an SIP. And if you'd like to know more about mutual funds, I've made another video on this. You can check it out over here.